Good morning, hi, it's Ross McInnes from Australian Investment Research Services. Thanks for joining us. This week we've been looking for the market to stabilise after capitulation type moves last week. This has happened to some degree, but we continue as per overnight to see fear and loathing in markets. The biggest issue is whether the European area is going back into recession on the back of the sovereign debt problems, and also now the new financial problems that they're having with their Eurobond yields and the euro falling away. This pressure continued last night with a story from the Financial Times that China was reconsidering its euro bond holdings, noting that China holds a $2.5 trillion US FX reserve from its trade surpluses over the last decade, and they're estimated to be about 630 billion euros held in that portfolio. In response, we saw Wall Street correct. It had been rallying into the European Open on the futures market side last night. The S&P 500 got up to 1,090 compared to 1,040 six-month lows that we saw on Tuesday night. The market still very brittle in terms of sentiment and ended up closing down. The S&P ended up closing down 0.5% at 1,062. The knock-on for this, again, as we've seen this week, is the SPI futures, Australian SPI futures index, falling 0.5% as well to 4265. The market's just moving up and down in a range. Set a low last week of 4175 on the open on Friday, and the overhead's around 4400. So at the moment, pressure's on the downside, but we're still just range trading until we get more clarity on what's happening in Europe. Same issues in foreign exchange. The euro dollar was rallying, got up to near 124 level, but got sold off on the Chinese story all the way down to 121.50. This compares to the 4-year lows we saw last week at 120, 120. The Australian dollar also following a similar path. We had expected last night for the Aussie to drift above 83.50, which it did. It had stopped buying orders above 83.50 and hit a high of 85.5. But in correlation with S&P 500, which continues to be the theme of the last 2 years, it fell away to 82.07 this morning. Has stabilised at 82.35. In terms of interest rates, the US bond market continues to act as a shock absorber for global investors in that they're buying that market to protect themselves from a potential second recession. US 10 years trading down at 3.19% still versus 4% highs at the start of the year. In commodities, we're seeing the market continue to drift a little bit higher, even though US dollar index is at 15-month highs at 84.4. Copper's 309 cents a pound this morning. Gold at 12.10 versus the record highs last week at 12.50, and oil is drifting back up to 70 after testing as low as $68 a barrel. On the day, some Australian data to focus on. March quarter capital expansion numbers. We had March quarter construction numbers yesterday, which looked a little bit soft from a private sector point of view. Public sector very strong from all the school building. So we're looking at about 1.4% rise. The other thing to watch is the anticipated CapEx in that series, which for 2010-11, although this series is a little bit out of date because it misses the negative effect of the resource tax, which we've seen over the last month. So overall, market's still attempting to factor in the chance of a European recession. In reality, we're not going to know whether this is real or not for at least another 3 months worth of data. So it's at the moment still at the hands of sentiment and subjective factors. So thanks for your time, and we'll see you tonight.